Selling puts is one of the best investment strategies in the world, and it's my favorite. This is one of my stock accounts. As you can see, I've sold puts on dozens of different stocks, from tech to consumer to defensive. A dedicated stock pool is really useful when selling puts. The good news is, it's not hard. It could be built gradually. Today, I'll explain 3 simple things: why a stock pool matters, what makes it different from a regular pool, and how to build one the easy way. Why a stock pool matters. Running a selling puts business is a lot like running a casino. A casino doesn't make money by gambling against players. It makes money because the rules give it a small statistical edge. Different games have different edges. Dice and blackjack have built-in asymmetries, while poker profits come from the rake. For selling puts, it is the premium we collect. But remember, in any casino game, the edge has to be small. If it were too big, nobody would play. Casinos make huge profits by accumulating small wins. They rely on having a lot of players. Now imagine a casino that has only one big player. If that player gets lucky, the casino could go bankrupt. It's the same for us when selling puts. If you only sell puts on one single stock, your risk is huge. But if you have a diverse stock pool, you're spreading your eggs across many baskets, and that makes your business much more stable. What makes it different from a regular pool? Here's the key idea. When selling puts as a business, you're mostly not making money from a stock's growth, but from collecting premiums again and again. So we focus more on downside safety than on upside potential. Even if a stock triples, your put premium stays fixed. So that's not the key issue. But managing downside is very important. If the downside is limited, your options will likely expire worthless, freeing up your capital so you can sell another round of puts. Even if you get assigned, it's best if it's only a small dip. Then you can either close the position or sell a covered call to collect more premiums. This helps you make the most efficient use of your capital, so our goal is clear: minimize downside risk. How to build one the easy way. Building a stock pool for selling puts is actually easier than building a normal stock portfolio. If Warren Buffett's stock picking is 99 out of 100 and an 80-point portfolio can make steady profits, then a 60-point stock pool can still do well for selling puts. Running a casino takes far less card-playing skill than being a professional gambler. Buffett has 3 filters for stocks: good business, good people, and good price. For simplicity, we'll focus on the first and the last. Let's talk about good business first. If you can do research, look at the business model, ROE, free cash flow, and so on. If you can't, use some simple rules. Low leverage is safer. Asset light is better. Pricing power is great. Strong network effects are even better. If that still feels too hard, here are 3 simplest ways. Pick the best companies in the industry you work in. Pick companies whose products you actually use. Copy what top value investors are holding. For example, if you work in tech, you probably understand how Google, Meta, or Temu make money. That gives you an edge. By the way, this is called circle of competence. If you're a consumer of certain brands, like Lululemon or Coca-Cola, you know why you buy them and you know their brand strength. That's exactly the Peter Lynch approach. Invest in what you know. Buffett owns Oxy, Len, and NUE, so I've added them to my pool too. Once you've picked a good company, you still need a good price. For beginners, when we talk about price, we don't mean the share price, we mean the company's market cap. When we talk about a good price, we don't mean a cheap stock. We mean a good valuation. The simplest metric, PE ratio. PE simply means if the company earns the same profit every year, how many years would it take to earn back its market cap? A high PE means a high valuation and less margin of safety. If you're a beginner, just avoid companies with PE above 30. If you're more advanced, you can adjust for different industries. For example, growth stocks like Nvidia can have higher PEs. If you don't even want to look at the PE, just avoid companies that aren't making a profit unless you're extremely confident in them. You don't need to build your entire stock pool at once. It's a dynamic process. Start small, sell puts on a few companies, and expand gradually as you gain confidence. Risk management rule: never sell more puts on a stock than you'd be comfortable actually owning. In US markets, one option contract is 100 shares. So if you're comfortable holding 300 shares, don't sell more than 3 contracts. Right now, my stock pool includes about 70 names across the US and Hong Kong markets. The more names I have, the more diversified my risks and the more opportunities I can find. Even though building a stock pool for selling puts is actually easier than building a traditional stock portfolio, better research and higher quality names will always make your pool stronger. Remember this: selling puts isn't about gambling, it's about managing probabilities. The more carefully you build your stock pool, the bigger your edge becomes. From 60 to 99, that's a never-ending journey of improvement. If you found this interesting, make sure to like and subscribe. I'm Faye. I've been investing for over 10 years with returns exceeding 20x. I share practical, easy-to-understand investment insights based on real experience. Of course, I'm not a financial advisor. Everything I share is for educational purposes only, not financial advice. Please do your own research and know your risk.